My name is Ron Harrison, and I am here with you from Unlimited Success Financial. We're part of the Five Rings financial family. And today we're going to talk about traditional banking system versus non-traditional financial strategies. When I talk about traditional banking systems, what I mean are the plans that have been around since the 1800s. In fact, the first savings and loan type of um, a business was set up in about 1831. And to be honest with you, our traditional savings plans have not changed much over the years. I mean, we have CDs and interest rate changes and things like that, but essentially they have not changed. Let's talk about some things about these traditional plans so that we can compare them to something that can be better. So I think of traditional plans. So let's just talk about this strategy. So for most people, they have their safe money, and their safe money might be in a savings account, it might be in a CD, it might be in a money market account. But when we talk about that, let's just think about the emergency fund that many people have. And let's say that has grown up to 20,000. I mean, this could be a savings account for a child or whatever. So sitting there in that traditional bank, earning, let's say they're generous and they're going to give you 4%. Of course, savings accounts, I mean, back in 2021 and 2022, savings accounts were paying about 0.5%. But let's just be liberal and say, hey, let's give you 4%. So that annual growth would be $800. So the new account balance at the end of a year would be 20,800. And let's say the person wants to take 10,000 out. And for this scenario, maybe they want to build a fence around their house or do some improvements or something, or take some money to buy their child a car for college, whatever it happens to be. So they take that 10,000 out. Now their savings account balance is down to 10,800. The annual growth on that, again, the 4% is going to be $432. So the new account balance is 11,232. So they're about $9,000 less than they had in their safe money account, emergency fund. Now, as we start looking at this, so let's think about what this does for a person. So the traditional savings accounts, you are in complete control. They're very easy to access. Easy liquidity, right? But here are the challenges with these plans that a lot of people don't realize until it bites them in the butt, so to speak, right? Visible to the IRS. Anything visible to the IRS can be taken by the IRS. Visible to hospitals. Let's say you have an unpaid medical bill. Hospitals can grab your money. Taxed annually. CDs and savings accounts are taxed annually. Of course, the tax is going to be little, but still, it's a taxable event. Who wants that? You make so little money anyway, you don't want to have to pay taxes on it. These are listed assets. So let's say there's a savings account in a child's name. They want to apply for college grants or scholarships and things. They may not be able to because this asset is listed under their name. Assets and savings accounts, traditional bank accounts, can be seized in court for debts that you might have, medical related debts, other financial debts that you might have, different suits and things, right? And then finally, there's no beneficiary bonus. Talk about that in a minute, but let's just say this: the person has this account, and the worst thing happens, some fatal thing happens. Their beneficiaries get $11,232. And the reason I mention that is because the plan we're going to talk about has a huge benefit bonus in it for beneficiaries. So let's go ahead and take a look at what I term the FLEXCash leverage plan. And the reason I call it that is because it's extremely flexible, not only in contributing to it, but also in accessing the money, and you get to leverage other people's money. Nearly all of us have heard about the idea of other people's money. That's what banks do. When you open up a savings account or a CD, you give the bank your money, right? What do they do with that? Well, banks, what they can do is they can take your money, let's say your $1,000, and they can loan that out 10 times. So they are leveraging your money for them to make money, aren't they? They pay you a little bit, they charge people a lot on their car payment, interest, their mortgage interest, whatever it happens to be. So since banks are leveraging other people's money, why don't we start leveraging other people's money, right? It seems smart to me. So same scenario here, $20,000 in this plan. Now these plans, if set up properly, they can be set up to get a 5% dividend rate. These dividend rates can vary from 4, 5, 6, even 7%, depending on the company. And we work with companies that have given dividends for 75, 100 years in a row. Even in 2008 when the market crashed, even in 2002 when the market crashed, even in 2022 when the market crashed, these companies gave dividends to their clients. That's amazing, isn't it? That's like guaranteed money. So the new account balance here is going to be 21,000. Then you're going to leverage other people's money. And what I mean by that, you get on the phone app and say, hey, take $10,000 out of my FLEXCash plan, put it in my personal bank account. Boom, boom, it's done. Now what happens though, the secret to all this, the money does not come out of your account. The money comes from the financial company. They loan you their money. So your 21,000 is still in there earning interest. Isn't that cool? And if it's 5% interest, so in year 2, this is going to earn 1,050. So this account, your actual cash will have $22,050 compared to $11,232 over here. So this is what you're earning interest on. Because when you took money out, this 10,000 to build your fence, the financial company loaned you their money, so yours is still earning uninterrupted compound interest. Let's see how important that is. So we think about the benefits to the FLEXCash plans. You're in control, just like over here, you are in control. Easy liquidity, easy liquidity. Here are the huge differences. These are invisible to the IRS. Let's say you have this plan set up for your child for college. You don't have to include it on the FAFSA form. That's amazing, isn't it? This money is never, ever taxed. You don't get a 1099 at the end of the year because the money goes in after tax. It comes out after tax. This is an unlisted asset. Does not have to be included in any type of court-ordered seizure or anything like that. So it cannot be seized in court. And there's substantial beneficiary bonus because these plans work through life insurance companies. Life insurance companies are the richest companies in the world for a reason, because they hedge their bets. They do the things right compared to the way banks operate. Now, when I talk about this being a life insurance plan, people say, oh, I hate life insurance, hate life insurance. Well, don't hate the product, because the product is what delivers. The product, the strategy, is what gives you all of this freedom. And the cool thing about this, if somebody had this sort of plan, it had this 22,000 in here, if the worst thing happened to them or a mortality issue, their beneficiaries could get 200,000, 300,000, maybe even $400,000 rather than just 22,000. Over here, the beneficiaries just get 11,000, right? So this is amazing. You have all that full control and everything, and then a giant pile of tax-free money goes to your beneficiaries. Let's take a look at a few other things. The banks use these all the time. The banks have, the last I looked, the last record I could find is at the end of 2020, banks had $182 billion in these plans. Why do banks go out and do something outside of their business? Because there are better things for them to do, right? They use them as tax shelters. They also use them as employee benefit plans. If you went to your bank and said, hey, bank, can you give me a FLEXCash leverage plan? They'd say, what is that? We don't do that. But they use FLEXCash leverage plans. Does it seem that your banker should also avail you of the things that he uses? Seems like it anyway, but they don't. These have been used by businesses for centuries, decades. Walt Disney, Ray Kroc, J.C. Penney, they use these types of plans to fund either the startup or the continuation of their businesses. I have a client that puts $1,500 a month in a FLEXCash plan. He's a small business owner. He has about $90,000 in there that he can reach in to buy inventory, pay employees when the times are slow, many different things like that, expand his business, whatever he wants to do. really so much flexibility on these. You can be your own bank, and you get security, safety, liquidity, and control. Those are the four main things we need to have with all of our money, don't we? But with your 401ks, 403bs, TSP accounts, even CDs. CDs, you don't have all this control because there are IRS and banking rules around CDs. With these products through insurance companies, you avoid all those rules. So you have the good parts about savings and traditional banking institutions. Then you have the better parts about what insurance companies can deliver. So if you want to learn more, right here at the bottom, you can see tinyurl.com/FLEXCash leverage plan. There's a short questionnaire there. And I will never call you, but I'll send you more information about these plans, and then we can talk specifics and see what you might want to do with that for yourself. So, thank you very much for listening, and we'll talk with you soon.